We had this situation where we had this sort of intermediate term warning in the market from 1122, where all three. So basically you have one intermediate term warning where you have both the McClellan oscillator and the McClellan volume oscillator below zero. At the same time, you get a new high in the S&P. We had that at the 2018 high and the 2020 high. And it's an intermediate term warning. And then if you also have the McClellan ratio adjusted summation index not being above plus 500, sort of a third element. So we had all three of those really for the first time since September 2018, just before that big correction. So we had an intermediate term warning, but we didn't have, and we had one sort of major internal that's been divergent for months, but most of them really were barely divergent. And so the concept there was that, okay, this is going to be something between a normal and an intermediate term correction, maybe, somewhere in between that. Now we had big decline. We had 90% down volume coming off of that pretty quickly off the highs, kind of adds to the warning status. And then very quickly this is actually, while this doesn't look like anything, and you say, oh, this isn't a correction, almost, it's just a normal thing on small caps and on these stocks and on a huge number of stocks. We've had double-digit declines. Growth stocks are down 17%. Small caps down 13%. So that's a decent correction for a lot of the market, and that's led to two indicators showing deeply oversold. So we could get a decent corrective low at some point. A lot of times when you get deeply oversold, you get a bounce or two, and then you get a decline below. So until we get a really confirmed demand response, you're still sort of being cautious and waiting and seeing how big this correction gets. As Chuck talked about, this level 4,500 that the S&P is trying to hold at, it's a really strong level. And if we get a correction over a really clear signal off of it, you can think you can take it. But I think that's a decent correction over, but we may get a little bit more than that. We may come back down and break that and get a bigger correction before we get a correction over. So we're going to watch what the market says here, definitely, and be cautious until we get something. And then thinking about the Omicron news and the narrative, you're probably going to get some volatility around that news. So far, the news seems good. Seems like it's light symptom, which actually could be the best thing possible. But as long as that news flow is coming out, intraday, if you're looking at intraday, some days last week and the week before, you're trading along pretty well in the market and you get in a rally, and then a news event came out on Omicron and you just got slammed very, very quickly. So it's a higher risk backdrop you want to realize until we start getting maybe 2 to 3 weeks out and start getting some better visibility on what that Omicron news is going to be like. And now the other thing that we want to watch until we get the clear correction over signal is if major supports are giving way. And so there's some major supports in small caps, this sort of 507, 508 level. In IWM, it's 205.70 here. And if this gives way on a closing basis, that's very negative. Chuck, in the futures, Chuck showed how the Russell futures have actually flirted with breaking below this point already. The cash has not, and it's testing in this area, and these March lows are really critical areas. So we had a false breakout that we bought into a bit, and then came back down. And now if you break out the other way and get follow through down, that's a very, very negative signal. We have the same thing. So we're watching this level, this 205.70 really level on IWM very closely. Small caps are where the majority of stocks are. And if they're really breaking down, that's a big problem. And then the same thing with this 15,950 on the New York Stock Exchange. Okay, so kind of until we get our correction over signal, you're trying to look at things like this to see, okay, how bad is this going to get? We get breakdowns in both of these that close below these levels. That's an indication that the correction is going to last longer and or be deeper. And so you just get a little bit more cautious. We have had some preliminary indications that where prior corrections have stopped. We've got the VIX into this sort of, so you can see we had the big decline, the major low. And then since then, really every single corrective flow has had the VIX coming back in this sort of 30 to 41 level where we've already gotten to. And we had big rate of changes that, kind of confirmed some of those. We've had that too. So the VIX is behaving as it would normally behave if this is a normal correction that was ending. Whether we get follow through clear demand response will be really important as to whether this is just a temporary pop or whether we're going to get a more sustainable rally. And then same thing with some of the sentiment indicators gotten extreme. This is the sort of 5-day MA, the put call ratio. You can see when it gets above this 0.55, the signals since the corrective low, it's been pretty good at telling you when you're going to get at least pops. Okay, so that's overdone. It doesn't mean that it can't keep going, but it means that this is an attempt at a rally mode. Omicron data over the next few weeks, as well as how severe government's increased restrictions are going to be important to the market narrative and to how volatile we get, whether we get some kind of news flow that knocks markets down again. So far, news has been pretty good. In the U.S., they're saying we're not going to fully increase restrictions. And so far, the symptoms coming out of Omicron in South Africa, where a lot of the people are not vaccinated. And so the vaccine's been really effective at cutting symptoms if you do catch COVID. It's been less effective at leading you whether you catch the next strain or not. So the people that brought COVID to the United States, this Omicron to the United States and to Europe, all are people that have had vaccines. But the one thing great about vaccine, if you've taken it, is if you do get sick, it's more like a flu. It's not going to be your odds of really negative symptoms go way down. All right. So this is just kind of where we are on COVID. We can see that we had spikes in new cases from prior variants, and we're kind of doing that again. The daily deaths, though, are not really rising to the same degree as the new cases because the symptoms from this Omicron seem to be lighter. And realize that in prior pandemics, light version that proliferated, that was kind of the last round of the pandemic. So there's a chance that this could be really bad or it could be really good. So Chuck's talking about how we're kind of at this potential turning point. We have to watch things really carefully from a narrative standpoint too. This could go a lot of different ways. You want to kind of get some kind of idea how that's going to play out before you bet really too heavily. Okay, this is from Goldman, and they're basically saying that the correction we've had already has priced in about the same sort of action that we got off of Delta and off of the prior variant. So the market is kind of treating this like it's treated Delta and not worse. And so as long as that holds up, you've got upside potential if we get a good correction over and the data starts coming out that it continues to be pretty low symptom. Okay, and then the other thing we've got going on is the tapering, and the sort of negative that put the market on more vulnerable footing before Omicron hit was that the Fed was talking about how inflation was temporary, and then we had mid to late October, core PCE inflation coming out and confirming it's the fifth month in a row where the monthly rate of change in inflation was coming down. In the Fed's most preferred indicator, that looked like, okay, the Fed's right. They're going to taper really lightly. Things are getting better. And then we had about 12 global reports of much higher inflation throughout the world and even in the US. And so the Fed has changed its tune quickly, basically said it's not going to use transitory in its language around inflation anymore, and they're already talking about increasing the rate of tapering. So that's been sort of a thing for the market, that the narrative switch, that's been a kind of a negative. This is how the S&P in black, how it performed in the late 2013 last taper. And you can see that it kind of had some volatility for a little while, and then we had a decent normal correction, pretty deep, not a major, but a decent correction. And then we started recovering, and then we had a much choppier rally than we'd had previously, but still trending higher. And so this is kind of one scenario you can think of for how the market behaved at the last taper. It's possible. Then it got into bigger problems when we started to talk about actual tightening. And so they're talking about potentially tightening late in 2022, maybe fourth quarter, something like that. So it's possible, if we don't get negative Omicron news, and if we can get a decent correction over and some follow through, that we could have a backdrop where you still got a rally or two before we start getting into some more negative scenarios. The other thing to realize, is I think this is a great quote from Milton Friedman that's really important to understand. And that is, the thing that you should keep your eye on is what government spends, because that's the true tax. In other words, when government is spending, if they're doing QE and spending QE, what they're really doing is cutting the percentage of the whole economy that your money buys. They've already taxed you. QE is a tax. It's a tax on every dollar out there. And so the thing to realize is that on a broad array of countries, really a lot of data shows that the higher you have the percentage of spending versus GDP, the lower the growth gets. So you do a regression of all these dots in different countries, different examples of that, and it's a pretty clear trend picture. The higher the percentage of GDP spent by government, the lower the growth rate becomes. We've just had massive spending. We're already at debt to GDP levels that also look like this, where the higher the debt goes, the lower the growth goes. So we've got a lot of factors actually slowing up potential growth. Just realize once we've filled a bunch of economic gaps and things like that, we start getting a more normal recovery. We still have like a 2% or lower potential sustainable growth rate because we have such high spending and we have such high debt. So at some point in 2022, that could come into play. The growth starts to disappoint, starts to behave more in line with what it does after a normal recovery, when you've got debts that are too high and government spending that's really high as a percentage of GDP. The other thing to realize about this backdrop is we look at this IBD 50 relative strength versus the S&P as a kind of a rough benchmark for how much our lists are going to outperform the broad market. And they outperform in nearly every environment, but they tend to outperform a lot better when we have both the short-term and the intermediate-term point and figure chart trending higher in terms of the relative strength of IBD 50 versus the S&P. And right now, we're in the opposite of that. We're in an area where the IBD 50 is trending lower on both the short-term and an intermediate-term basis. It's just broken down from the 50. It's just broken down from a double top here. We can come back and start to be strong, but if we don't, that's an environment where you got to realize that, okay, till we get a correction over signal and we start to see better relative strength in growth stocks and in smaller mid caps, you've really got a pretty narrow group of stocks that are outperforming. A lot of those are mega caps that make up like 50% of the S&P. The S&P, take the 10 biggest cap stocks and it's nearly half the index. So when you look at the S&P, to a large extent, you're looking at 10 mega cap stocks. You're not looking at the thousands of stocks in the market. So just realize that the backdrop is not conducive to massive outperformance until we get some improvement in these indicators. In our ETF list this month, we've got we look at ETFs, we look at what groups are doing really well. We do pluralities, looking at Chuck's WHAM relative strength on all of the IBD groups, 197 of them. And really, there's not a lot showing really strong upside plurality right now because we're in this correction. The ones that are holding up best and still showing up decently include some semiconductors, some market research, some building, some trucking, some retail, and some alt energy. And then those holding up relatively well are short-term REITs, industrial real estate, carbon credits, and dividend achievers. So your first shot, particularly if you're using ETFs and groups and not individual stocks, these are probably some of your first forays and maybe stocks in these groups after we get a correction over. And you're going to watch these really carefully as the correction end comes and we start to see strength. Which one of these not only held up well, but are also outperforming as the rally gets underway? That's where you're going to have your outperformance and your real leaders.